Hey, Jason Boice from Executive Real Estate, and today we're going to answer a question from Instagram from my favorite sister-in-law. Shout out to Vanessa Boice. And she asked, how do I know if it's the right time to buy for me or the market? So we're going to take a quick look, try to break it down. But basically, it's going to break down to need and affordability. So a couple charts here. We're looking at the Case-Shiller U.S. Home Price Index. Case-Shiller Index is based off of 20 metropolitan areas to come up with the best attempt at an average for the country. So we'll start with that. You can see down here, Case-Shiller Index starts in 1987. And since 1987 all the way up into 2008, home prices never once really dropped until 2008. You see here, when the infamous housing market crash happened, and prices didn't start to recover until 2012, and then you're at where we are today, historically the highest in the Case-Shiller Home Price Index we've ever had. So we're also going to look at, this is a chart of the 30-year mortgage interest rate, also starting in 1987 going up to present day. And you'll see this chart actually has about an inverse relationship with the Case-Shiller Home Price Index. The reason for that being is because as mortgage rates go down, affordability goes up, right? So you can afford more house, the lower the interest rate. Now that's not the sole reason the housing price index is so high, but it's a contributing factor. So let's take a look at that. So here we have a $200,000 loan at 3% interest. Your payment's $843 a month, and you're paying $103,000 in interest over the life of the loan. On a $200,000 loan at 4% interest, you're paying $955 a month and $143,000 in interest over the life of the loan. That 1% difference in interest rate is an extra $112 a month and an extra $40,000 over that 30-year period. Now that's on a $200,000 loan. Let's take a look at what if it's a higher dollar amount loan. So on a $400,000 loan at 3%, you're paying $1,686 a month, and that's $207,000 over the life of that loan in interest. If that same $400,000 loan goes to 4% interest, our payment's now $1,909 a month, and you're paying $287,000 in interest over the life of the loan. To take it a step further, if that same $400,000 loan goes up to 5% interest, the payment's now $2,147 a month, and you're paying $373,000 in interest over the life of the loan. So just to give you, just so you can compare, that same $400,000 loan at 3% versus 5%, you're paying an extra $461 a month, and over the life of the loan, you're paying an extra almost $166,000. So as you can see, as interest rates go up, the amount of house you can afford goes down, but as interest rates go down, the amount of house you can afford goes up. So while the price may be high, the affordability aspect is still manageable. The other thing about housing is due to appreciation, right? Values tend to go up over time, which is a good thing if you're an owner. So to get back to the question, how do I know if it's the right time to buy for me or the market? Based on historically what housing prices do, I'm going to say you can't really try to time the market. Now, if you're an investor, if you want to have some dry powder ready for when you think it may go down, that's another story, so that you are ready to pounce on lower prices. But if you're looking to buy a house, I mean, if it's 1990 and I wanted to wait for prices to come down, I would have been waiting all the way to 2008. It's a long time to wait, right? And, right, the trend is that they're always going to go up. So if you want to wait now for another crash or another downturn, I mean, based on looking at historical timeframes, you could be waiting another 20 years, right? So that's why it goes on need, right? If you need to buy a house, go buy one. Especially now with interest rates the way they are, you can afford, technically more than you think you can afford, because the payment is so low. One thing to be on the lookout for, interest rates are starting to tick up. A lot of the information I'm reading from National Association of Realtors, from a lot of different banking industries, is a lot of people are starting to anticipate interest rates, which are right now today in the low 3s, to be in the 4s by the end of 2022. So keep that in mind. The amount of house you're going to be able to afford is going to get more difficult. So in trying to answer that question, really breaking it down to need and affordability, right? If you need a house now, I wouldn't put it off just because you think a downturn may be coming. If you look at statistics throughout history, you might be waiting a really long time. And you might also miss, right, that appreciation that continues if you're waiting for a downturn. So I hope that helps. If you have any questions that you would like me to answer on Just a Tip Tuesday, send me a message and I'd be more than happy to answer. Until next time, thank you.